Welcome to our first 2023 Bob Binney Wealth Management webinar. The title of our webinar today is State of the Markets 2023. I'm Bob Binney.
I'm Jessie Thompson.
And we just want to welcome you here. Before we get into our webinar topic and the State of the Markets 2023, I want to share with everybody, because we have a pretty big audience today, kind of a recap of Christmas. I had a great Christmas. You had a great Christmas. We hope all of you had a blessed and great Christmas. But sometimes you just get really super special Christmas presents. And this year I got a special one. Hillary, Jesse's best friend, who started working for us a couple months ago, she got me a special gift, maybe my favorite Christmas gift this year. And she knows that I love fishing and that I love Jesus. So she got me this. If you can see it, hopefully you can see it. It's a picture of me and Jesus in a boat fishing. And what she did was she captured this off of an episode of The Chosen, which I love also. If you haven't watched The Chosen, it's probably the best show on the face of the earth, in my opinion, because Jesus is in it. But there's a scene in there where Jesus is in a fishing boat with Simon Peter and his brother Andrew, and she photoshopped my face into there. So I wasn't really with Jesus in that boat. It's a fake, but it's still pretty fun.
Just so everyone knows.
Just so everyone knows. In all truth, in all candor.
So before we get into things, I just want to explain to you guys, we're going to be going through a lot of information. If you have any questions while we're going through stuff, we'll address all of the questions at the end. And you can ask those by typing them in on the question box in the bottom of your screen.
Of course, if you have questions later, you can sure email us or call us at the office or whatever. But if you want to try to do it during the webinar, do it that way.
Yep. So let's just jump right in. 2022 was a rough year for investors and for the stock market. There was a lot of turbulence in 2022. All of the major market indexes ended up in the negative. The S&P 500, which is the 500 largest stocks on the New York Stock Exchange, which is a pretty good reflection of the U.S. stock market as a whole, ended at negative 19, approximately minus 19%. The NASDAQ ended at negative 33% approximately, and the Dow ended at about negative 9%. Now, a lot of people think about the Dow when they think of the stock market, but just as a heads up, the Dow is not a very good reflection of the overall U.S. stock market. It's only made up of 30 companies. And so if there's a large price swing in one of those companies, it can throw off the entire index. It's just not a very good one to use. The S&P 500 is a lot better to go off of. And then lastly, surprisingly, the U.S. core bond index, which is made up of investment grade bonds and government bonds, actually went down 12.9%. And that's the worst return that it's ever had in its existence, which it came about in 1999. And a lot of people think about bonds as being investments that are safe during market downturns. And as we'll talk about later, bonds are not safe, not always safe. It just depends on what the economic situation is.
And so far this year, the year-to-date performance of those indexes is, as of right now, because I have it right on my phone, I'm connected through Yahoo Finance on my phone, the NASDAQ is up 3.65% for the year since January 1st. And the S&P 500 is up 1.6%, just in a matter of whatever, 19 days of the year so far.
You've had a really good start.
Had a really good start. I feel like, you know, that we reached the bottom of the stock market, at least as of right now. The bottom of the stock market last year was early October before the election. I think the market kind of figured out that probably the Democrats weren't going to win everything. The Republicans were at least going to get the House, and that was going to stop this rush towards communism of Biden and the Democrat Party. And that was going to be good for capitalism, which is good for the stock market. So it started going back up. But of course, time will tell. We dealt with a lot of turbulence in 2022. is due to a mixed bag of uncertainty. And the uncertainty was pretty much all driven by the news media and the government and the mainstream news media, that is, worries about interest rates going up and high inflation and the war in Ukraine, and then the uncertainty over the election. Uncertainty scares the stock market, especially scares the day traders or the people that are trying to time things. And so midterm election years are consistently bad for the stock market, but we're past that. And I'll tell you one thing, Jesse. The reason the market goes down is when there's more people selling than buying, right? But the most famous investor in Nebraska, in Omaha, in the United States is Warren Buffett. He's not selling and wasn't selling last year. And so if nothing else, follow his wisdom.
So kind of moving on to our expectations for 2023 and what you can do to prepare for 2023. Before we get into it, I want to make a point that nobody, including us, can predict what's going to happen in the stock market short term. If somebody tells you they can, they're a liar, and ask for their track record. If you read kind of articles that come out with like market or economic forecasts, things like that are all over like Yahoo Finance or any financial website, those market strategists are wrong most of the time. There was a study that was done that actually found that they're only right 47% of the time. So flip a coin. You know, you might as well flip a coin. They could be right or they could be wrong. So just that's something to take into an account, that the stock market is unpredictable in the short term. But what we do know is that in the long term, it's going to trend upwards as long as companies are profitable and innovating. So that's what's positive. Keep that in mind. We don't have a crystal ball, but we're going to do our best.
Yeah, and one thing to keep in mind is the media, particularly the mainstream media, but also the financial media. They're in business to get you to read their papers or their stories or watch their news or watch their programs or listen to them on the radio or whatever. That's what business they're in. They're in business to get you to keep your attention on them. We're in business to give people financial advice. It's a different thing. And so we're not fear mongers like the news media is. And we're going to use our observations, my 27 years experience and Jesse's 9 years experience, and our education, along with common sense, to tell you what our best idea of what we think 2023 will bring and how you can prepare. So some major expectations for 2023. You were supposed to say that, I think. That's all right.
Thanks for covering for me.
Yeah. We're going to have more inflation. It's going to keep going, and it's going to be high, and it's going to be bad for a while. The inflation is inevitable because of all the money the government has printed out of thin air. They've increased the supply of US dollars in the world by about 30% in just the last 2 or 3 years. And so the government is 100% to blame for what's going on in our economy and for this inflation. Printing money directly causes inflation, and it increases the money supply and devalues the dollar. If you have $100,000 worth of money, or $100,000 in the bank today, earning next to nothing in interest, and you leave it there, and we have 10% inflation, a year from now, you're going to be able to buy $90,000 worth of stuff at today's prices, or at the prices then. And it's just going to keep going worse. That's why it's so important to have your money positioned wisely to protect yourself against inflation, which is the biggest financial threat to all of you.
And just to talk a little bit about how we got here, this is a direct result of the government's actions in 2020. for COVID. So it's a direct result of the COVID measures that they took and the spending that they took of that, and then also the government shutdowns that bottlenecked things and messed with the supply.
And it's not just in 2020, but it's
In demand.
2020, 2021, and 2022, and they're still trying to keep COVID going now, as we saw from the news a couple of days ago.
Just an interesting fact for some perspective, World War II is the United States' most costly war in our history. And depending on what source you get this number from, the cost of that adjusted for today's dollars is around $4.5 trillion, give or take. Some are a little bit higher, some are a little bit lower, but they're all over $4 trillion. Okay, for perspective, the US has spent so far on COVID relief measures, $11 trillion. And you can see everything that they spent that money on. If you go to covidmoneytracker.org, that's where you'll find that number and all the spending. But it's shocking. And that's what got us to the position that our economy is in right now.
So back to the major expectations of 2023. The first was more inflation. The next is a possible recession. And the reason for the possible recession is that the government's only response to inflation, their only way to fight off inflation is to raise interest rates. And that, they cause this inflation with the printing and the spending of money, and their only solution that they have, their only tool is raising interest rates. And if they increase interest rates too fast and too much, it causes a recession. And some market turbulence surrounds these Fed meetings that when they're seeing or predicting that the Fed's going to increase interest rates, then you'll see the stock market drop because of the fear of recession. But let's talk to them about the stock market performance around in recession times.
Yeah, a lot of times I think people fear recessions because they associate a recession with a stock market crash. Recessions are a normal part of the economic cycle, first off. Second off, just because there's a recession, that does not mean that there's going to be a market crash or even mean that there's going to be a market downturn. So historically, if we look at how the stock market performs during recessions in the past, you'll see that the average cumulative return, so that's the return during the entire time of the recession, is negative 1.5%. If you take 2007 through 2009 out of that, the return would actually be positive on average. So you'll see that in some of these other recessions, they have a pretty good return, 18%, 16%, 14%. That's more than the average return for the stock market, which is around 9 to 10%. So it doesn't necessarily mean that there's going to be a market crash or that the market's going to go down just because there's a recession. And then also, if you take a look at how long these recessions have lasted in the past, they're pretty short-lived. A lot of them are only months long. So recessions are not something to be terrified about when it comes to the stock market.
Thank you. So another major our expectation for the stock market for 2023 is there's a lot of positive stock market indicators, or some positive stock market indicators. That the most thing is that these companies are making money, and their ultimate intrinsic value is what their earnings are. And so one of the measures that analysts use to evaluate companies and buying versus selling and whatnot like that is called the PE ratio. It's simply the price of the stock divided by their earnings per share, which is also the same relationship as the value of a company divided by its profits. And so this is kind of a weird graph that she's showing you, because it's not a graph of the stock market. This is a historical graph over the last 10 years of the price earnings ratio of the S&P 500, those 500 largest stocks on the stock exchange. And so a low number is when the stock market is undervalued, and a high number is when the stock market is overvalued. And as you can see at the end where the pointer is right now, the stock market is kind of relatively undervalued historically to where it should be. So this is really a buying opportunity. Now, the earnings for the whole year of 2022 aren't out yet. The fourth quarter earnings are just starting to be reported by all these publicly held companies right now. But it is pretty clear that if it is even a drop from one year to the next, from 2021 to 2022, it's not going to be anything significant at all. As always, there's companies that didn't do well in 2022, and there's companies that did great in 2022, but that's normal as competition. Some people do the right things, and some people try harder, and some people have better ideas and they thrive, and others don't, or maybe just have bad luck. But it's all, the earnings are there. Trust me, the earnings are there. And then another positive stock market indicator, I believe, is the election that we had in November, because the bottom was reached in the stock market, all-time bottom, or the bottom last year in the stock market was in October. And I believe that at that point, the overall general stock market figured out that probably the Democrats were not going to retain both the House and the Senate, and that at least the Republicans were going to take over the House. And the reason that's important is if the Democrats, have the House and the Senate, and they have these communist leftist ideas that we've all seen happen over the last couple of years, that's just going to keep going on. It's going to get worse, and they're going to put the gas pedal to the floor, rushing towards communism, like we've seen them doing. But because the Republicans, even though they had a slim majority, they took over the House, they're going to stop any bills that are taking away freedom or increasing taxes or doing things that's going to hurt capitalism and the free market and freedom. And so that gives me a lot of optimism for what's going to happen this year with the stock market, because the stock market's all about capitalism. There's a big war across the world, and even in our country to some extent, between two economic systems, capitalism and communism. And the stock market's all about capitalism. So I think capitalism is winning, and it's going to win. And so there you go. That's my story, and I'm sticking to it.
So let's talk about some strategies or tips for the year ahead that we think that you should utilize. The first one is prepare, don't predict. We talked about earlier that it's impossible to predict the short-term performance of the stock market. Long-term investments in the stock market have great results. The longer you hold an investment in the stock market, the greater the likelihood that you're going to come out with a positive return. So,
and by the way, this doesn't mean you shouldn't make adjustments between companies or between areas in the stock market as time goes on. It's just generally being in the stock market long term yields great results.
Okay, so if you hold an investment in the stock market, and they're talking about the S&P 500 index here, so a fund that reflects the S&P 500. If you hold it for 1 year, you have a 73% chance of getting a positive return. If you hold it for 5 years, you have an 87% chance of having a positive return. If you hold it for 10 years, you have a 94% chance of having a positive return. And I believe for 20-year holding periods, there's no period in the stock market history that hasn't come out with a positive return over 20 years. So those are pretty good odds.
So it's all about time in the market, not market timing. People who make market predictions tend to try to time the market. And that's the definition of market timing. So here's how it usually goes. This is just like a hypothetical drawing of the market.
And somebody's the psychology behind market timing.
Yeah.
And generally, market timing is trying to get into the market for only the good times and be out of the market for the bad times.
And it doesn't work. And I'm going to show you why, because this isn't just because I got this off of this chart. I've watched this happen in my 27 years watching investors. And so if the green line is the market, you know, going up and then going down in a big dip and then going back up, here's how people think. At the beginning, they see the market going up. They go, oh, I see a trend. I should watch this market. And as it goes up, they at some time, they decide to buy. And they buy near the peak. And then it goes up. And then it starts going back down. And they think, oh, well, I'll use this correction to increase my exposure to the stock market. I'm going to buy some more here.
Thinking this is the extent of the correction.
Yeah.
Because they don't know.
Yeah, they don't know.
Nobody
and then
knows.
It goes down some more, and then they buy some more. And then as it keeps going down, at some point they start to panic. And then when it goes clear down, usually near the bottom, that's when they sell. And I can tell you that, Jesse, over my 27 years of experience, I can almost time the bottom to markets by the calls of people, of the panickers calling up and saying, hey, I think we should get out. Because right about the time that happens is right about the time that right after that, the market turns around. So then the market turns around or is at its near its bottom, and the person after they've sold, it goes down a little bit more, and they you know, they think, well, it starts coming back, and then they think, oh, it's still going to fall. And then as it's going back up, it keeps going up, but they're still afraid of it going back down again. And they don't end up buying back into the market to about the same point of where the stock market was before they got out, or sometimes they buy in higher, so they actually lost money versus if they just stayed in. And so that's that's how people, that's just general human emotions with markets, and most people have them, and that's why that's why we have a job, because we know more about this stuff than people that don't deal with it every day. We have the experience and the education, and I'm a total non-panicker. I don't panic. I use experience and tools and education to try to make educated decisions and recommendations for our clients, and that's what we do.
So studies have consistently proven that market timing, this concept we've just talked about, doesn't work and actually loses people money in their portfolios more than just sticking out a bear market or a downturn actually does. Because remember, a bear market or a downturn comes back. Once you sell, you've locked in whatever loss that you have. So I know we've talked about a lot of these different studies and stuff, but I thought I'd bring kind of a new one to the mix. And this is a comparison of an investment in the S&P 500 over approximately the last 20 years, $10,000 investment. So someone who invested in the S&P 500 starting in January 1, 2002, remember we had 2008 during this time period. Right? That's a time period that a lot of people probably wish that they weren't in the market. But this person invested 2002, kept their investment the entire time. And this is talking about them investing in the S&P 500 in this example. They would have gotten 9.52% average annual return on their money each year. Okay.
Their 10,000 would have gone up 6 times to over $61,000 in that 20-year period.
Even with 2008.
Right.
Okay. Now, another person who missed out on only the best 10 days of the market over that approximate 20-year period would have only got half the return that this person who stayed in the entire time got. And it gets worse the more days that people were out of the market. What's important to note about this is that the very best days of the market usually occur in a bear market or in the middle of a downturn. And a lot of times they occur right next door to the very worst days of the market, the days when people would think that they should get out of the market. And so this is just another study that proves and shows that time in the market is better than trying to time the market.
That's good information, Jess. So ups and downs are unpredictable and a normal part of investing. The best thing you can do is to prepare yourself for those ups and downs and have a portfolio that matches the amount of risk that you're willing to tolerate. And we have some tools that we use to help people understand how much risk they can tolerate and the different kinds of risks. And we help people develop portfolios that will match the amount of risk that they're willing to accept.
And then our second tip or strategy is invest based on principles and not based on narratives. So you don't see the very richest investors in the United States using market timing. Okay, they use something called value investing. That's something that Warren Buffett uses, and they invest based on principles, not on narratives. So remember that a company's stock price is made up of two different values. It has its intrinsic value, like its true underlying value, which is based on how profitable the actual company is and what their earnings are. Okay, and then it has this other portion of its price that's based on how much an investor would buy or sell that investment that very moment.
And that decision is based on emotions, on human behavior.
And narratives.
And narratives.
From the news
It's typically driven by the news media. The news media, remember, whose job is to get you to keep watching or listening, not to give you good financial advice. But the news media drives these narratives to capture your attention, oftentimes to stoke fear, because if you're afraid, you're going to watch the news media more often. And most of the time they're wrong. And, you know, just like through 2022, they said that, you know, run for the hills, and interest rates are going to go up. Inflation is you know, going to kill the stock market. The war in Ukraine is going to kill the stock market. There's a recession, on and on and on. Those companies are still making money. Many of them are making more money than they were before, and they're healthy. Their price went down because the news media stoked this fear, but it's going back up as the truth comes out, and as we get through past this election, and that sort of thing.
So kind of a funny little chart that we've shown before is that CNBC does this markets in turmoil special.
And this is a very busy chart, but every little date on there, every date is every time that they had a markets in turmoil special. Okay. And it shows this, what the stock market did, the S&P 500 close was in the next column there. And so this column that she's pointing out right here is the return the year after the CNPC tried to scare the crap out of everybody with a markets in turmoil message. And look at those double-digit returns. It's unbelievable how well the stock market did after the financial news media expert CNBC said markets are in turmoil. If somebody was pretty smart and sharp, they could just invest right after CNBC tells you it's time to get the heck out of the markets, and every one of those is green. Every one of those is positive, every column.
And they haven't updated this since May 5th, 2022, but you get
it's still good enough.
Yep. So the narratives that temporarily influence the stock market, those are temporary, right? Earnings are a much better indicator or source of information to go off of when you're investing than narratives are.
And the earnings are healthy. The earnings were staying pretty healthy through 2022. There may end up being a drop when it's all said and done, after all the companies have reported this month. As of the last quarter of 2022, they reported in January, only 4% of companies are reported right now. There may be a little bit slight drop, if anything, but they're still very strong. As always, there are winners and losers. Some companies are innovating and trying and thriving. as an example is Shields here in Lincoln, Nebraska. You know, you go through all the time through the COVID stuff and all this stuff where some other companies are going out of business or failing. Shields parking lots packed. It's because they try. They have a great return policy. They have great service. They're friendly. If you buy a Traeger grill there, they'll put it together for you and deliver it to your house. I'm a big Shields fan, aren't I?
Yes.
Yeah. Don't come in the office and bring up Shields, or I'll tell you a lot of stories. But anyway, they're successful because they're trying and they're working hard. And that's the way other companies are. The companies that try and keep working and have good ideas and serve their customers thrive. And the companies that don't, they start drifting down. That's normal. And overall, in this country, companies are doing pretty darn well.
Our third tip or strategy is know how much risk you can handle. You are going to be a lot, you know, market volatility or turbulence or downturns are never like super comfortable, but you're going to be a heck of a lot more comfortable if your portfolio is invested according to your actual risk tolerance of how much risk you can handle. And a financial advisor can help you with that. So there are many different kinds of risks that come with investing. Investing in the stock market has market risk. There's interest rate risk that bonds are susceptible to. There's financial risk that companies have of maybe going bankrupt, maybe not having earnings show, maybe not doing well. There's inflation risk, just to name a few of the different risks that come with investing.
And the problem is a lot of people, when they're thinking about risk and investing, they're only thinking about the risk of the market going down and them losing money. Well, number one, guarantee you the market's going to go down. It's going to go down and up, down and up, down and up, down and up, and over time go up. And you only lose money when you sell when it's down. If you hold on to it, it'll come back up. I'm saying in general with the stock market. I'm not talking about any individual company.
Not for like failing companies, yeah.
Failing company. But most people only think about market risk and they ignore what is the greatest financial risk to all Americans right now. And that's this high inflation. And the reason it's the greatest risk is because they printed all this money. You lose buying power with your money. You have $100,000 in the bank today. You can buy $100,000 worth of stuff with it today. If there's 10% inflation in the next 12 months, you'll only be able to buy $90,000 worth of stuff. Another double-digit inflation, $80,000 worth of stuff. And it doesn't come back. It's kind of a permanent loss in buying power generally is what inflation does to you.
So if you are somebody who finds yourself having a really hard time when there's a lot of turbulence in the market and you feel really uncomfortable, there are products that have insurance features on them, different kinds of investments that aren't like a direct investment with the stock market. They'll have an insurance feature on them that can kind of protect you a little bit and act as kind of a buffer for that stock market risk.
You're still tied to the stock market and you get the gains of the stock market, but you don't have as much of the risk, and you're going to pay for that. You're going to pay for that insurance protection. There's a trade-off, just like if you didn't pay for the homeowner's insurance on your house and you never had a fire or a tornado, when you died, you'd have more money than if you. So anyway, those are particular products that are semi-complicated, that if that's something that you're interested in learning about, you're going to have to come in and we're going to have to explain it to you and give you the ins and outs on it and decide if that fits your situation. But what everybody needs to be sure they do is to position their portfolio to hedge against inflation.
That's our fourth tip.
That's our fourth tip. Thank you. Fourth and final tip. Position your portfolio to hedge against inflation. There's basically, I'll do this kind of quick because we're 35 minutes into this, huh? Anyway, there's three bad investments to be in during high inflation, and three good places to have your money during high inflation. The three bad places are cash, checking or savings in the bank, because you don't earn enough to stay ahead of inflation. You lose buying power. The second is CDs, very similar. You might make a little more interest than you do in cash than you do on savings or checking accounts, but the interest rate on CDs never is ahead of inflation. And you lose buying power. And the third is bonds. And bonds, although they seem safe, bond market values over on this hand and interest rates over on this hand, it's an inverse relationship. So if interest rates go up, bond market values go down. And I believe that interest rates are inevitable to continue to go up because of the inevitable inflation, because of all the money that the government has printed. They're going to keep going up. And so those are the three bad places to have money, or places where you lose buying power in high inflation environments. The three good are, first off, if you think about what inflation is, it's the rising cost of goods and services. And when I say that to people in the office, every time I say that, they go, yeah, that's what inflation is. Well, a logical great hedge against the rising cost of goods and services are to own the companies that produce and sell the goods and services for a profit. And so that's logical. I can also prove it to you with some in the office, if you want to see it, with the historical performance of the stock market when we had super duper high inflation before, which was the late 70s and early 80s. Depending on what time frame you're looking at or what years you look at, the S&P 500 made anywhere between 15.5% and 16.5% per year, outpacing inflation by 8.5% per year. It's the best hedge against inflation because it's kind of fitted in with inflation because they produce and sell the goods and services whose prices are going up. So that's the first one. The second one is income producing real estate. With income producing real estate, and when we have inflation, both the real estate value and over time your rent will go up. And then the third is gold. And gold is a hedge against inflation, but I don't like it as much as real estate because it doesn't produce any income or any rent. And I don't like it as much as companies because it doesn't produce a good or a service whose prices are going up.
So to close, it's our job as financial advisors to help our clients and help you position your portfolio in a way that can withstand ups and downs of the market over your investing life. And it's also our job to make sure that you don't make mistakes that can cost you a lot of money, such as panic selling or getting out at the bottom of the market by trying to time it. So when we give advice or say that now is the time to stay the course or now is the time to buy, that's because that's actually the best strategy, not just what we believe, but that's backed up by
our experience and historical facts.
So we're going to answer any questions that anybody has had right now.
And by the way, if you have, as Jesse's pulling up this question, if you have any any family or friends, if you have any family or friends that need some help or need a little hand holding or something like that, please don't hesitate to send them our way. We'll treat them like gold. We always treat your family and friends like gold. And we'll do our very best to help them with advice and counsel and hand holding, whatever it is we need to do. And that not only includes on investments, but the other parts of wealth management that we help people with, as far as estate planning or income tax planning, that sort of thing. The question that came up is, do I have any predictions on fishing this spring? And that's from one of my buddies that's been on a fishing trip with us, on some fishing trips with us. And my predictions are that there will be a lot of fishing going on this spring. So thank you for that question, Ron. Anybody else, if you have any questions, you can call our office at 402-421-2626 or email Jesse at bobbbenny.com or me at bob@bobbbenny.com.
And if you have any feedback on this webinar or tell us how we did, tell us if there's anything that you would like us to talk about coming up on future webinars, that would be super helpful as well.
Or if there's anything you really don't like,
hated it.
if you hated anything, you can
Don't
tell
tell
us.
us.
And well, you can tell us, I don't know, we can take it. We just want to make it better. We want to help people, and hopefully we can help people with giving you this information. So thank you very much and have a blessed day.
Thank you.